Welcome back. Today, we will learn about the Earned Income Credit and the Additional Child Tax Credit. Let's begin with the research question from Chapter 5. Joe and Sally qualified for the Earned Income Credit, but Sally did not have a valid Social Security number by the due date of the return, so they were unable to claim the credit. Sally obtained a valid Social Security number in November. May they amend their return and claim the Earned Income Credit? Yes, if the amended return is timely filed. Yes, they can file an amended return if a Social Security number is issued in the same year. No, the Social Security number must be issued by the due date of the return, including extensions. No, the Social Security number must be filed with the original tax return. Pause and think about it, then resume when you are ready for the answer. Did you guess C? No, the Social Security number must be issued by the due date of the return, including extensions. If you did, then you are one smart cookie. This is correct because the taxpayer has until the due date of the return, including extensions, to obtain the Social Security number. The first answer here says yes, if the amended return is timely filed. This is incorrect because the taxpayer is only able to amend the return if the valid Social Security number was received before the due date of the return, including extensions. The second answer says yes, they can file an amended return if a Social Security number is issued in the same year. This is incorrect because the valid Social Security number must be received before the due date of the return, including extensions. The last answer says no, the Social Security number must be filed with the original tax return. This is incorrect because the taxpayer can amend the return if the valid Social Security number was received before the due date of the return, including extensions. For example, the return is filed January 20th without a Social Security number. The taxpayer receives the Social Security number April 1st and files an amended return at that time. The answer can be found in Publication 596, page 5, under the No Social Security Number heading. Great work on that one. Now, let's look at our objectives. In this session, we cover a lot of ground. At the conclusion of this chapter, you will be able to distinguish between refundable and non-refundable credits, determine eligibility for the Earned Income Credit, compute the Earned Income Credit, apply the due diligence requirements for the Earned Income Credit, determine eligibility for the Additional Child Tax Credit, compute the Additional Child Tax Credit, and apply the due diligence requirements for the Additional Child Tax Credit. As you can see, due diligence is a big deal around here. Let's begin with a look at credits and deductions. Remember the page with the layout of federal tax return in the introduction section. Layout of an income tax return in the beginning of your participant's guide. You may find it helpful to have this image up as we discuss deductions and credits. Let me ask you this. What is the difference between a deduction and a credit? I'll give you a second to think about it. Okay, your 1 second is up. Deductions reduce the amount of a taxpayer's income that is being taxed. Let's be clear that a deduction does not reduce the tax liability dollar for dollar. Credits, however, do reduce the taxpayer's amount of tax due, dollar for dollar. Where are deductions and credits reported on Form 1040? Let's take a look. Here we see deductions have arrows pointing to them and credits are highlighted in yellow. Take a look at lines 12 and 13. Notice how deductions are entered before taxable income, and unlike deductions, credits do not come into play until after the tax has been determined. Then, credits may be used to reduce the tax liability already determined, dollar for dollar. Credits need to be computed generally in the order they are presented on the Form 1040 and accompanying schedules. The specific adjustments to income are covered in the Additional Income and Adjustments to Income chapter. The qualified business income deduction is also a deduction for certain business income. Once we understand the difference between a deduction and a credit, we need to next distinguish between a non-refundable and a refundable credit. Let's review what the difference is between a refundable credit and a non-refundable credit. Non-refundable credits do not reduce a taxpayer's amount of tax due below $0. However, refundable credits allow the taxpayer to get the credit as part of their refund, even if their tax has been reduced to zero. Notice we have two sections, one that says tax and credits and the other says payments. So one could say that refundable credits are considered a type of payment, so to speak, where are non-refundable tax credits located on Form 1040. We see them here on lines 19 and 20, after the tax on line 18. We then subtract the non-refundable credits from the tax. Notice line 22 cannot be less than 0. Some non-refundable credits are first entered on Schedule 3 before being entered on Form 1040. Ponder this. Where are the refundable credits located on Form 1040? They are entered on lines 27, 28, 29, and they can be carried from Schedule 3 to line 31. They are added to federal income tax, withheld, and counted as a payment. Therefore, they can result in a refund over the amount of tax due. Let's look at another visual of this. Credits need to be computed, for the most part, in the order they are listed on Form 1040 and/or Schedule 3. The IRS stated that as of December 2024, 23 million families and individuals received about $64 billion in one refundable credit, with an average amount of $2,743. Which one do you think it is? The Earned Income Credit, EIC, is often referred to as the Earned Income Tax Credit, EITC. These acronyms may be used interchangeably, though in this course, we use the EIC acronym. The Earned Income Credit is an example of a refundable tax credit that may be available to modest income earners. Does the Earned Income Credit require a qualifying person as a dependent? Earned Income Credit does not require a person to have a child or children to be eligible, but the amount of the benefit will vary depending on certain factors, one of which is how many children the taxpayer has. The dog and cat represent a taxpayer with no children who qualify for the Earned Income Credit. The pets are not a requirement, of course. Unfortunately, pets are not tax deductible either, but I digress. The maximum amount of the Earned Income Credit for 2024 is $7,830. To receive the maximum amount, a taxpayer would need to have 3 qualifying persons. Imagine your tax refund including $7,830. That's a decent amount, and now you can see why your due diligence is so important. The maximum amount for a person with 2 qualifying persons is $6,960. The maximum amount for a person with 1 qualifying person is $4,213. The maximum amount for a person without any qualifying persons is $632. What do you notice about these numbers? The more children you have, up to 3 children, the higher the maximum EIC. Let's talk about the qualifications for everyone first. Then we'll look at the rules that involve qualifying dependents. To qualify for the credit, all taxpayers must pass 7 requirements. What happens when you stick a pin into one of these balloons? It pops and everything begins to fall. The same is true for these rules. Think of these 7 rules with the same frame of mind. All 7 of these rules must be met, regardless of having a qualifying person or not. If the taxpayer does not meet the requirements for any one of these rules, they do not qualify for the Earned Income Credit. What are the 7 rules for everyone? These are located on the Rules for Everyone page if you want a reference point. The list of requirements for everyone begins with having a valid Social Security number by the due date of the tax return, including extensions. They must meet certain requirements if they're separated from their spouse. They must be a U.S. citizen or resident alien all year. They must not file a Form 2555, Foreign Earned Income. They must not have more than $11,600 of investment income. They must have earned income, and they must have AGI under the required limits for their filing status and number of qualifying persons. Active duty military personnel stationed outside the United States are an exception to the 3rd rule above and are treated as living in the United States for Earned Income Credit purposes. Let's look at each in more detail. What is a valid Social Security number for purposes of the Earned Income Credit? The taxpayer and any qualifying persons for Earned Income Credit must have a Social Security number issued by the Social Security Administration by the due date of the return, including extensions. The Social Security number must be valid for employment. What if a taxpayer doesn't have a Social Security number before the due date of the return? If they anticipate receiving their Social Security number before the extension due date, they should file an extension. Here's an example. A taxpayer or spouse just became a citizen, and they don't have their Social Security number yet. They file an extension prior to the due date of the 2024 return, which is April 15, 2025. They receive the Social Security number before the extension filing deadline for 2024, which is October 15, 2025. They are eligible for Earned Income Credit regarding this requirement. What if the taxpayer receives their Social Security number after October 15, 2025? They cannot qualify for the Earned Income Credit for tax year 2024. They can try again for the 2025 tax year. What if the Social Security card says not valid for employment on it? The taxpayer would not qualify for the Earned Income Credit. Concerning married taxpayers not filing a joint return, the rules for the credit have some exceptions. Let's look those exceptions. Have you noticed a trend with the married filing separately status? If so, what kind of a trend? Taxpayers using the married filing separately filing status may have more stringent rules or may lose out on credits, such as the Earned Income Credit. If the taxpayer is married and not filing a joint return with their spouse, what certain requirements must be met to claim the earned income credit? They must be married and not filing a joint return. They must have a qualifying person who lived with them more than half of the year. They also need to have either lived apart from their spouse at least the last 6 months of the year or are legally separated according to state law and lived apart from their spouse on the last day of the year. Married taxpayers who qualify for head of household should meet these requirements if they lived apart from their spouse the last day of the year. Remember, a married taxpayer can only file head of household if they meet requirements 1, 2, and 3A, plus maintain 50% of the cost of maintaining the home. Let's look at rules 3 and 4 next. For the U.S. citizen or resident alien rule, does that mean a U.S. citizen could live outside of the United States? Yes. For this rule, it only states the taxpayer must be either a U.S. citizen or a resident alien all year. As we progress through some of the other rules, we will find that certain taxpayers also have to live within the United States for at least 6 months of the tax year. We are not going to be studying Form 2555 in this course, but what does it pertain to? Foreign earned income. The form is used to exclude foreign income earned or foreign housing from gross income. Let's look at Rule 5. What is the 5th rule for claiming the earned income credit? A taxpayer can claim the earned income credit if their investment income is $11,600 or less. Language is very important when we interpret the tax code. If a taxpayer has investment income of $11,600, can they claim earned income credit on their 2024 tax return? Yes, notice the rules state they can claim earned income credit if their investment income is $11,600 or less. What is considered investment income? There are examples of investment income covered in the Wages, Income, and Taxes chapter. If you're thinking of taxable interest, dividend income, or capital gain net income, you get Gold Star. There are a few other types of investment income, but they include advanced topics not covered in this income tax course. If you want to learn more, refer to Chapter 1 of Publication 596, Earned Income Credit, for more information. Let's move on to Rule 6. Why do they call this credit the Earned Income Credit? Because of this 6th rule, the taxpayer must have earned income to qualify. What are some examples of earned income? Wages, salaries, tips, net earnings from self-employment, and gross income received as a statutory employee. Additionally, taxable retirement benefits received from an employer's disability retirement plan until the taxpayer reaches the minimum retirement age of their employer are considered earned income. This type of income is reported on Form 1040, Line 1H, and is included when determining earned income. This type of income will be discussed in the retirement chapter. It's important to note employee pay is earned income only if it is taxable. There is an exception to this rule. Do you remember what it is? Non-taxable combat pay. A taxpayer can choose to include it in earned income. If you're in the armed services, this is a small thank you for your service. Lastly, we have Rule 7. Adjusted gross income limits are shown here. Why do these amounts matter as far as for qualifying for the EIC? The taxpayer's adjusted gross income must be less than these amounts. The number of children or no children dictate the maximum amount for AGI. Would a single taxpayer with 2 children and an AGI of $48,500 pass this requirement? Yes, as long as their AGI was under $55,768, the taxpayer would pass this requirement. Would a married taxpayer with 3 children and an AGI of $63,397 pass this requirement? Yes, as long as their AGI was under $66,819. The taxpayer would pass this requirement. Now that we have covered the EIC rules for everyone, let's look at the next step after a check for understanding question. Which of the following is not one of the rules for anyone wanting to claim the EIC? Earned income is only allowed from wages, tips, and salaries. The taxpayer must have a valid Social Security number by the due date of the return, including extensions. Investment income must be $11,600 or less. The taxpayer cannot file Form 2555. Pause to think about it. When you're ready, let's review the correct response. Did you guess that A is correct? Bullseye. Earned income is only allowed from wages, tips, and salaries is correct because earned income includes wages, tips, and salaries, as well as self-employment income, non-taxable combat pay, and certain disability benefits. The taxpayer must have a valid Social Security number by the due date of the return, including extensions, is incorrect because this is one of the rules for everyone. Taxpayers must have a valid Social Security number to claim the Earned Income Credit. A card that says not valid for employment is not a valid Social Security card for Earned Income Credit. Investment income must be $11,600 or less is incorrect because this is also one of the rules for everyone. Taxpayers cannot have investment income over $11,600 and claim the Earned Income Credit. Investment income includes interest and dividends. The taxpayer cannot file Form 2555 is incorrect because this is also one of the rules for everyone. Taxpayers cannot claim Earned Income Credit if they are excluding foreign income. Thank you for a job well done. Now, on to qualifying for the Earned Income Credit. The rules for claiming the Earned Income Credit differ depending on whether a qualifying person is involved. We'll begin by reviewing the rules for taxpayers without a qualifying person. After that, we'll look at the rules for those with a qualifying person. Pop quiz time. Don't worry, I'm going to give you the answers. For a taxpayer without a qualifying person, what is the age range to qualify for the Earned Income Credit? Taxpayers must be at least age 25 and under age 65. Can they be claimed as a dependent? No, they cannot be claimed as a dependent or be an Earned Income Credit qualifying person of another taxpayer. What if they qualify to be a dependent but their parents don't claim them? No, they cannot claim the Earned Income Credit for themselves. Is there a time when a qualifying person can claim the Earned Income Credit? Yes, there are two exceptions to a qualifying person claiming the Earned Income Credit. If the individual's parent or another person for whom the individual is defined as a qualifying child is not required to file an income tax return and either 1. Does not file an income tax return. 2. Files an income tax return solely to obtain a refund of withheld income taxes. They must have earned income below what amount if they are single with no qualifying person? That's right, $18,591. Earned income must be below what amount if they are married filing jointly? Yes, $25,511. Now we need to share the rules for the Earned Income Credit if a taxpayer has a qualifying person or persons. Let's recap. To qualify for the Earned Income Credit, taxpayers without a qualifying person must be at least 25 years old and under the age of 65. If filing MFJ, only one spouse is required to meet the age test. Not be able to be claimed as a dependent on another taxpayer's return or an Earned Income Credit qualifying person of another person. Live in the United States more than half of the year. Have earned income and AGI of less than $18,591 or $25,511 if married filing jointly. When you have a taxpayer with low income who is within the age range, it is important to consider their eligibility for the Earned Income Credit without a qualifying person. How long must they live in the United States? More than half of the year. What if the taxpayer is military personnel stationed outside the United States? Are they excluded from the Earned Income Credit because they were not in the U.S. for more than half the year? No. Military personnel are considered to have lived in the United States, even if they were stationed outside the U.S. on extended active duty. I think we've earned, get it? Earned? Another check for understanding question.